With respect to investment properties, there's pros and cons of using bank financing versus seller buyer financing. With bank financing, it's much more straightforward and traditional. You have a bank, a third party, lending funds to acquire a commercial building or real estate, and there are terms and covenants in that loan. Typically it requires a down payment of anywhere from 10 to 30%. The closing takes about 90 days, give or take. An appraisal was required that's satisfactory to the bank. Obviously, there's a pre-qualification process, an underwriting process that you have to go through with a bank. But once you do all that, and assuming you have the wherewithal to close the transaction, now your relationship is with the bank and ensuring that the debt is serviced properly. With seller-based financing, typically the seller would give the buyer a promissory note. The buyer would give the seller a promissory note, and the buyer would be responsible for making payments to the seller. There's pros and cons there. The pros are obviously you don't need to go through everything that I just described with commercial financing, with bank financing rather. You don't need to go through due diligence and underwriting. The cons are, it's probably going to be more expensive. You're probably going to pay a higher rate of interest, and also the satisfaction of buying the seller out is gone because the seller technically still has a security interest in that property. So you're going to be dealing with the seller. Also, depending on the sophistication level of the seller, that could create future hurdles. For example, the seller asking questions about the financial performance of the buyer, asking to see books and records of the buyer to ensure that the buyer has the financial ability to service the debt. So each set of financial possibilities, whether it's bank-based financing or seller-based financing, has its unique set of challenges and benefits. I think if you're flipping real estate and you're doing so successfully, first of all, congratulations, but secondly, you definitely need good legal counsel in your corner. There are consequences to selling real estate so quickly. For example, ensuring that the adequate covenants and clauses are incorporated in your purchase sale agreement and escrow instructions. Also making sure that there's no trailing liability after you close the deal. And making sure that you're adequately protected from a tax perspective. Now you've got to put that money somewhere else to ensure that your tax liability is mitigated. So yes, having good legal counsel, even in the context of simply flipping residential real estate, is important. So one of the big considerations that you have to make with respect to acquiring commercial real estate is your loan to value. That means what's the value of the real estate versus the loan that you're going to be able to finance on the property. Banks typically will lend anywhere from 70 to 80% on a transaction, depending on the guarantor's credit, depending on the balance sheet of the borrower, and underwriting, of course. So that means that you've got to have a sufficient equity cushion in order to buy the real estate, and that would be in the form of a down payment. But beyond that, one of the things that I've seen with clients is they have enough for the down payment, they close the transaction, but they don't have anything left after the transaction closes. And typically, there's still a lot of work to be done after the transaction closes. You have improvements that may or may not need to be made, compliance issues, an HVAC system may break, plumbing issues, things that are totally unanticipated that need to be accounted for after the closing should be there as well. So in that loan to value, I always add an extra 5 or 10% of a cushion. I advise my clients that way to ensure that there's enough runway to both close the deal and to have sufficient capital after the deal closes.